Welcome to the Deep Dive, your essential shortcut to cutting through the noise and, well, truly understanding the topics that shape our world. We've all been there, haven't we?
Oh, definitely.
You're scrolling through the news, maybe catching a quick update, and a term like core inflation rate pops up. You might nod along, think you've got the gist, but deep down, maybe it's a bit fuzzy.
It can feel like trying to grasp smoke sometimes, yeah.
Exactly. So today, we're diving deep into core inflation. And our goal isn't just to understand it ourselves, but to arm you with the kind of crystal clear insights you'd need if, say, you wanted to make a really helpful video explaining it. We're aiming for signal, not noise.
That's absolutely the mission. Because, while it sounds technical, grasping this one metric, it's almost like getting an X-ray view into the wider economy.
An X-ray view, I like that.
And maybe even more importantly, it reveals the thinking behind those big policy decisions from central banks, like the Fed here in the U.S.
Okay. And we're drawing this from somewhere specific today.
We are. Our insights come from a really solid, clear source called Understanding Core Inflation and Its Economic Impact. It lays things out step by step, which is perfect for distilling it down.
Great. So let's unpack it. If someone wants to get their head around this, maybe explain it simply in their own video.
Yeah.
Where do we even start? What is core inflation, really?
Yeah.
It sounds like normal inflation, just filtered.
You're spot on. It's exactly inflation with a very specific, very intentional filter applied. Basically, core inflation is the inflation rate, but it leaves out two big categories known for being, well, super volatile.
Okay, which ones?
Food and energy. So think groceries, gas prices, electricity bills, all that stuff that can jump around a lot.
Right.
Instead of tracking every single price change, core inflation tries to focus on the underlying, more persistent trend in prices. You usually see it measured using things like the core CPI Consumer Price Index or the core PCE, which is Personal Consumption Expenditures Price Index.
Okay, that's where it gets really interesting for me and probably for anyone listening. Why on earth remove food and energy? I mean, aren't those things we buy, like, constantly?
They absolutely are. And that's a fantastic question. It really gets to the heart of why core inflation is even a thing, why it's so useful.
So why take them out?
The reason is precisely because their prices can swing so wildly, often for reasons that have almost nothing to do with the fundamental health of the overall economy. Think about it, a sudden drought.
Right, crop prices shoot up.
Exactly. Or a flood. Food prices can soar overnight, but that doesn't mean the whole economy is suddenly overheating, Or maybe OPEC decides to cut oil production, or there's geopolitical tension.
Or a hurricane hits the Gulf Coast.
Perfect example. Those events cause dramatic, often temporary spikes or drops in energy prices. They're big shocks, but they might not last. So these short-term things, these often supply-related issues or external shocks, they can really distort the true underlying picture of inflation.
Distort, like ripples on a lake.
That's a great analogy. They're like surface ripples that hide the deeper current. By removing food and energy, economists and, crucially, central bankers, they get a cleaner look at the persistent structural inflation.
Oh, the stuff driven by broader things.
Yeah, like overall consumer demand being really strong, or maybe wage growth picking up across the board, or just the general amount of money flowing through the economy. It's about seeing that deeper current, figuring out if the economy itself is genuinely running too hot, or if it's just reacting to, say, a temporary oil price jump.
That lake analogy really helps. Seeing past the surface ripples to the real current. Okay, so if this core current is what central banks like the Fed are watching so closely, how does their focus on that number actually hit us? Our wallets, maybe our mortgage, a business thinking about expanding. What's the practical takeaway here?
Right. This is where understanding it becomes really empowering, because for central banks, and especially the Fed in the U.S., core inflation is pretty much their main guide, their go-to gauge when they're deciding on interest rates.
The big decision.
The biggest. Their core belief, based on, decades of economic history, is that stable prices are just fundamental for a stable, growing economy. Think about the crazy inflation in the 70s, or the opposite, deflation during the Great Depression. Both were disastrous. So if core inflation is running consistently high, meaning prices are climbing broadly, not just your gas bill, it's a strong signal the economy might be overheating, it points to a more ingrained problem.
And if it's low?
Well, conversely, if core inflation is too low, that might suggest demand is weak, the economy is sluggish, maybe even risking deflation, which is also a big worry. So for them, it's not just a number, it's like a vital sign they use to steer the whole economic ship.
Steering the ship, avoiding the rocks of inflation or deflation.
Got it.
Okay, let's get down to brass tacks then. For our listener, maybe thinking about explaining this simply. How does a high or low core inflation number actually affect my ability to buy a house, or my credit card bill, my job? Make it personal.
Okay, absolutely. This is where it really connects. Let's break down those real-world impacts. So when core inflation is high, first, the Fed's response. If core inflation stays persistently above their target, we'll get to that target later, they're very likely going to raise interest rates.
Okay, pump the brakes.
Exactly. They want to make borrowing more expensive to slow down spending and cool the economy off.
And for me, the consumer.
For you, that means higher borrowing costs, pretty much across the board. If you have a variable rate mortgage, your payments could go up. Credit card interest rates, they'll likely rise. Getting a new car loan or a personal loan, more expensive.
So buying a house gets tougher.
Definitely. Higher mortgage rates mean bigger monthly payments, or you qualify for a smaller loan. Your purchasing power generally shrinks because your money just doesn't stretch as far.
And what about businesses?
Businesses feel it too. It costs them more to borrow money for, say, building a new factory, hiring more people, or buying equipment. So they might postpone those plans, maybe slow down hiring. And if consumers are cutting back too because things cost more, businesses could see sales slow down. It just creates a tighter, more cautious environment overall.
Okay, that makes sense. So what about the flip side, when core inflation is low?
Right, the flip side. If core inflation is consistently below the Fed's target, it suggests the economy might be too cool, demand is weak. So the Fed's response is likely the opposite. They'll lower interest rates.
Trying to get things moving again.
Precisely. They want to encourage borrowing, encourage investment, encourage spending, basically stimulate the economy, get the engine revving.
And for consumers, that means.
Cheaper loans, lower mortgage rates, more affordable car loans, lower credit card interest. Sounds great.
Sounds pretty good, yeah.
And it can be, but there's a however. Consistently low core inflation might also signal weaker overall economic growth, and that could potentially lead to wage stagnation over time. So even if borrowing is cheap, your paycheck might not be growing much.
Ah, okay. A potential downside there, too.
Yeah.
And for businesses and maybe the markets.
For businesses, lower rates make it cheaper to borrow, so they might be more inclined to expand, invest, hire people, potentially good for job growth. And in the markets, lower rates often make stocks look more attractive compared to bonds.
Why is that?
Because future company profits are worth more today when discounted back at a lower interest rate. So you often see stock prices rally. Bonds might rally too, because lower interest rates generally mean higher bond prices.
So it's clear this core number isn't just some abstract thing. It really does ripple out everywhere.
Well,
Let's push that view a bit further then, especially for someone looking at investments. How does core inflation weave its way through the stock market, bonds, and what about something like Bitcoin? You hear that talked about as an inflation hedge sometimes.
yeah, it absolutely impacts investments, and sometimes in ways that might surprise people. Let's take stocks first,
Yeah.
particularly what we call growth stocks. Tech companies, innovative firms whose value is tied mostly to expected future earnings. High core inflation and the higher interest rates that usually come with it can really hurt them.
Because future money is worth less today.
Exactly. Those future earnings get discounted more heavily, so their valuations today drop. But not all stocks react the same. Some sectors might actually do okay, or even well. Think energy companies if energy prices are part of the broader inflationary pressure, or utilities, which are often stable, or consumer staples, the companies selling necessities. People still need soap and food, right?
Yeah, essentials hold up. What about bonds?
Bonds are, well, pretty directly affected. If you own a bond, you're getting a fixed payment. But if core inflation is rising, the actual purchasing power of that fixed payment goes down over time.
It buys less stuff.
It buys less stuff. So naturally, investors will demand a higher interest rate, a higher yield on new bonds to compensate for that erosion. And what does that mean for existing bonds with lower fixed yields? Their prices generally fall. So high or rising core inflation is usually bad news for bond prices.
Okay, bonds get hit. Now, Bitcoin and crypto. The digital gold idea.
Ah, yes, the digital gold narrative. It's often pitched as a hedge against inflation, something that will hold value when dollars lose theirs. The theory is appealing.
But the reality.
The reality, or at least the historical performance so far, has been, well, a bit different. Bitcoin and many other cryptocurrencies have tended to behave more like what traders call risk assets.
Meaning
They tend to go up when interest rates are low, there's lots of money sloshing around, and investors feel confident taking risks. And they tend to go down when interest rates rise and investors get more cautious, more risk-averse.
So more like tech stocks than gold in practice.
Often, yes. So instead of reliably moving opposite to inflation, they've often moved more in sync with general market sentiment and risk appetite. That's a really crucial distinction for anyone thinking of them purely as an inflation shield.
That is a crucial distinction. Okay, so we know what it is, why it matters, how it affects us, our loans, our investments. We talked about high and low. Is there like a target? What's the Federal Reserve actually aiming for with this core inflation number? What's the sweet spot?
There absolutely is a target, and it's surprisingly specific and public. The Federal Reserve explicitly aims for 2% core inflation.
You would present.
And they specifically use the core PCE measure, that personal consumption expenditures index minus food and energy. That 2% isn't just pulled out of thin air. They believe it's the rate that signifies a healthy, stable economy.
Not too hot, not too cold.
Exactly. It's high enough to keep away from the dangers of deflation, which can really stall an economy, but low enough to prevent runaway inflation that eats away at everyone's savings and causes instability. So, for anyone watching the news trying to figure out what the Fed might do next, that 2% is basically your North Star. If core inflation is consistently running above 2%, say it's hanging out at 3% or 4%, you should probably expect the Fed to be talking about and likely implementing interest rate hikes.
Try to tap the brakes, bring it back down.
Bring it back towards 2%. And conversely, if core inflation dips consistently below 2%, then you should expect the Fed to be considering rate cuts or maybe other ways to stimulate the economy to try and nudge inflation back up towards that target. It really is their guiding light for keeping the economy stable.
Wow, okay. That 2% target really anchors everything. So let's bring it home. And for you, the listener, maybe absorbing this to finally get a clear handle on it, or perhaps to make that simple, helpful video for your audience, what's the single core takeaway message?
Yeah, the bottom line. Core inflation shows us the underlying price trend in the economy once you strip out the short-term, often dramatic swings in food and energy. It's the key signal the Federal Reserve watches when making those huge decisions about interest rates.
The signal, not the noise.
Exactly. And because you understand that connection now, you indirectly get a much better sense of why your mortgage rate might be changing, why the stock market is doing what it's doing, maybe even why crypto prices are moving. It cuts through the headlines and helps you see the real economic pulse. It's powerful stuff.
And that's exactly what we aim for here at the Deep Dive, giving you that shortcut, that clear understanding of crucial, sometimes complex topics like core inflation. You're now equipped with knowledge that helps you make much more sense of the financial world swirling around you, whether you're just trying to stay informed or, maybe even preparing to share that insight yourself.
Absolutely. And maybe a final thought to leave with everyone. Now that you understand how core inflation acts as the signal for Fed actions and how that impacts everything from loans to markets, what specific economic signals, maybe in the news or in your own finances, are you going to start paying a bit more attention to? Something to think about.
A great question to ponder. Stay curious, everyone.